In April 2026, global financial markets are preparing to absorb an offering designed to rewrite the mathematical parameters of corporate valuation. Space Exploration Technologies Corp. Is moving toward an initial public offering. According to a confidential SEC draft filed this April, the aerospace manufacturer is seeking to raise up to $75 billion. If executed at the upper bounds of its target, SpaceX will clear a market capitalization between $1.75 and $2 trillion. This chart illustrates the extreme math required to justify that number. Based on the company's estimated 2025 revenue of roughly $16 billion, a $2 trillion valuation means investors are underwriting a trailing price-to-sales multiple of 125 times. To see the severity of that premium, we must compare it to the most highly valued technology conglomerates on Earth. The combined trailing price-to-sales ratio of the entire Magnificent Seven cohort sits at just 87.8. SpaceX is demanding a multiple that dwarfs the peak AI hardware cycle. For context, NVIDIA's trailing multiple for the same period clears at 35.4. The market is not arriving at $2 trillion based on current launch logistics or satellite internet revenues alone. They are pricing in a highly speculative, multi-decade vision heavily promoted by Elon Musk, the deployment of a 100-gigawatt space data center to serve as the computational rails of a post-terrestrial AI economy. Because this specific, highly leveraged bet requires institutional capital to execute at scale, the asset becomes aggressively gatekept. And when retail capital is excluded from an asset of this magnitude, it inevitably forces the creation of high-risk, engineered backdoors. Historically, participation in major pre-IPO value creation was strictly reserved for venture funds and ultra-high net worth accredited individuals. The 2026 market environment has catalyzed a massive disruption to this legacy gatekeeping. To capture the retail capital sidelined by institutional walls, the Web3 ecosystem has constructed a sprawling shadow market of tokenized private equity. This infrastructure relies on two primary mechanisms to bypass traditional financial gates: decentralized special purpose vehicles and centralized synthetic derivatives. We must dissect the exact mechanical architecture of these tokens to understand why they are currently generating severe, irrational pricing anomalies. Understanding these structural risks and regulatory constraints is essential. When the SpaceX IPO finally triggers a formal liquidity event, it will stress test every single pillar of this unverified system. Before digital asset tokenization, the only mechanism to access pre-IPO equity was through traditional secondary platforms. By late March 2026, robust trading activity on these legacy platforms had pushed SpaceX's implied valuation to $1.29 trillion. However, platforms like Forge Global and EquityZen operate under strict regulatory exclusionary zones. They require participants to hold formal accredited investor status, typically demanding a net worth exceeding $1 million. Beyond the net worth constraints, the operational bottlenecks are severe. Minimum investment thresholds frequently begin at $25,000, and the transaction infrastructure is highly manual and paper-heavy. This manual friction manifests in what is known as a settlement cycle. In the legacy secondary market, it routinely takes between 30 and 45 agonizing days for a trade execution to become a legally binding ownership transfer. High capital barriers, exclusionary regulatory requirements, and draconian settlement times combine to create a massive liquidity vacuum in the pre-IPO space. Blockchain protocols aggressively stepped in to fill this void. By migrating these assets to distributed ledgers, they introduced continuous fractional ownership and near instantaneous trade execution, allowing participation for as little as $10. Yet, while blockchain infrastructure brilliantly solves the mechanical bottlenecks of accessibility and liquidity, it achieves this entirely at the expense of systemic legal safety. The most direct attempt to translate traditional equity into a digital asset is the decentralized special purpose vehicle model, utilized heavily by platforms like Prestocks. The architecture works like this. An off-chain entity, the SPV, acquires physical private shares from secondary sellers. Once secured in custody, the protocol mints mapping tokens onto the blockchain, generated at a strict 1-to-1 ratio to the physical equity. But this creates a severe legal fracture. Holding the token grants strictly economic exposure. You receive zero legal equity, no voting rights, and absolutely no standing to pursue recourse if the target company undergoes bankruptcy or corporate restructuring. It relies on a facade of decentralization. The on-chain token is immutable, but the asset backing it is completely reliant on an off-chain human manager. If that manager misappropriates funds or faces regulatory seizure, the digital token instantly devolves into a worthless certificate. The second dominant architecture abandons physical shares completely. This is the centralized synthetic model, exemplified by products like BitGet's IPO Prime platform. In this system, retail investors deposit stablecoins into a centralized exchange to purchase a structured derivative note. This note strictly tracks a reference index pegged to the target company's projected future performance. To be absolutely clear, there are zero physical SpaceX shares involved in this pipeline. The product operates entirely independently, with absolutely no authorization or review from SpaceX itself. This introduces profound, multi-layered counterparty risk. Because settlement relies entirely on an eventual public listing, investors are exposed to massive downside via time decay. If Elon Musk decides to indefinitely delay the public offering, the derivative bleeds value. In a near-frantic race to deliver frictionless settlement speed, both models sever the legal bond of direct ownership, replacing it with varying degrees of proxy risk and blind trust in digital intermediaries. When you combine the engineered scarcity of pre-listing supply with immense retail demand, the resulting collision generates massive, irrational pricing premiums. We can observe exactly how this market inefficiency operates by examining the tokenized trading of the pre-IPO artificial intelligence firm Anthropic. This graph establishes Anthropic's intrinsic private market valuation, clearing at $380 billion during a February 2026 funding round. Yet synthetic tokens on decentralized aggregators violently decoupled from that reality. Secondary trading pushed the implied valuation to an astronomical $851 billion. Financial markets usually self-correct through a mechanism called arbitrage, but here we see total arbitrage failure. Because these tokens cannot be converted back into physical private shares prior to an IPO, there is no mechanical bridge available to close the gap between the token price and the actual private market value. Investors allocating capital into these tokens are not securing fundamental aerospace or AI valuations. They are simply absorbing a massive structural premium derived entirely from retail fear of missing out. Without a functional arbitrage bridge to enforce reality, these pre-IPO tokens cease to operate as coherent investments, functioning instead as highly hazardous, speculative momentum vehicles. The aggressive expansion of these retail premiums has forced the U.S. Securities and Exchange Commission to build a decisive regulatory wall against offshore tokenized assets. Operating under the legal doctrine of substance over syntax, the SEC mandates that changing the technological form of an asset into a digital token does not override federal compliance laws. The economic substance dictates the rule, regardless of the syntax used to code it. However, the U.S. financial establishment is not ignoring the technology. The SEC recently approved a rule change allowing NASDAQ and the Depository Trust Company to launch a pilot program for highly compliant institutional equity tokenization. But to build a compliant system, NASDAQ had to intentionally throttle the core feature of Web3. They specifically rejected instantaneous on-chain execution. Atomic settlement is the instant one-to-one execution of trades. It's fast, but requires massive capital transfers and eliminates error correction windows. Compare this to multilateral netting, where thousands of trades aggregate into a clearinghouse. Only a tiny fraction of net capital differences changes hands. By intentionally forcing tokenized trades to settle on a standard trade plus one-day clearing cycle, institutions preserve multilateral netting and maintain the structural stability of the global market. The takeaway is clear. Web3's defining feature of atomic settlement is fundamentally incompatible with the systemic clearing mechanisms required to safely list a $2 trillion enterprise. As we approach the end of 2026, the digital tokenization ecosystem has successfully solved the problem of private market accessibility, but it engineered a highly hazardous environment defined by zero legal equity and profound counterparty risk. When SpaceX finally lists on a public exchange, a massive, historic flood of institutional and public capital will wash over the market. The moment that public liquidity connects with the isolated shadow market, It will instantly crush the artificial scarcity premiums holding up the retail tokens. Synthetic token holders will suffer immediate, severe post-IPO drawdowns as their highly inflated entry prices violently decouple from the reality of the institutional book-building process. The impending mega IPO will certainly test the financial viability of off-world digital infrastructure, but more importantly, it will serve as the ultimate stress test to determine if decentralized ledgers can ever integrate with legacy capital markets without shattering the essential mechanics of global clearing.